What if the most powerful force shaping your future was never elected, never debated, and rarely even noticed? And what if it quietly decided the fate of entire nations long before you were born? Most people are taught that governments control money, that budgets are political choices, and that economic crises are unfortunate accidents. But this story begins with a mystery that challenges all of that. How did a small group of financial institutions gain the power to influence wars, recessions, inflation, and the daily cost of your life without ever appearing on a ballot? To understand when central banks quietly took control of every nation's future, we have to go back to a time when money was simple, limited, and deeply inconvenient for those in power. For most of human history, money was tied to something real: gold, silver, land, labor, and governments could only spend what they could tax or physically obtain, which meant wars were expensive. Empires collapsed when they overreached, and rulers faced real limits. But those limits were exactly the problem for growing states. Especially as trade expanded, wars became larger, and political promises became more ambitious. So the origin of central banking begins, not as a conspiracy, but as a solution. In 1694, the Bank of England was created to lend money to the government for war, and in exchange, it received something revolutionary: the legal authority to create money as debt, setting off a chain reaction where borrowing replaced saving and promises replaced hard limits. And once governments realized they could spend tomorrow's money today, the rise of central banking accelerated across Europe and later the world. With institutions designed to stabilize economies but quietly shifting power away from parliaments and toward unelected bankers who controlled credit, interest rates, and money supply. The cause and effect was subtle but profound, because when money is created as debt, someone must always owe. Growth becomes mandatory, and crises become inevitable. And as central banks gained credibility, governments became dependent on them, especially during emergencies like wars and depressions. Which brings us to the breaking point in the early 20th century, when global finance collapsed under the weight of speculation and inequality, leading to the Great Depression, a moment often framed as a failure of markets, but which also marked a turning point where central banks gained unprecedented authority to intervene, manipulate rates, and act as lenders of last resort. And from that moment on, every major crisis became a justification for more power, not less. After World War II, the Bretton Woods system tried to put limits back in place by tying currencies to the US dollar and the dollar to gold. But this was a fragile compromise that depended on trust, and by 1971, that trust broke when the United States closed the gold window, effectively severing money from any physical anchor. And this is where the quiet takeover became complete. Because fiat money, money backed only by confidence, requires constant management, narrative control, and intervention, all of which placed central banks at the center of global power, determining interest rates that shape housing markets, deciding how much money exists, and indirectly choosing who benefits from inflation and who pays for it. The fallout has been decades of rising debt, asset bubbles, and inequality. Because when new money enters the system through banks and financial markets, those closest to the source benefit first, while wages lag behind prices, creating a hidden transfer of wealth that most people feel but can't quite explain. And every attempted fix, from quantitative easing to zero interest rates, has treated symptoms while deepening the underlying dependency, making economies more fragile and governments more constrained. Because once debt reaches a certain level, raising rates risks collapse, and lowering rates fuels bubbles, trapping policymakers in a cycle with no easy exit. Today, the modern parallels are impossible to ignore. With global debt exceeding hundreds of trillions of dollars, central banks coordinating policies across borders, and ordinary citizens facing inflation that erodes savings while being told it's temporary, necessary, or beyond anyone's control. Yet the pattern repeats exactly as it always has: crisis, intervention, expanded authority, and normalization. And the most shocking data point is not any single number, but the trend itself. Each decade requires more debt, more stimulus, and more control to maintain the illusion of stability. So what does this mean for the future, and more importantly, for you? The first takeaway is that money is not neutral. It is a system of power, and whoever controls its creation shapes society's outcomes. The second is that central banking didn't take control through force but through dependency, offering solutions in moments of fear that permanently altered the balance of authority. And the third is that no system based on endless debt can remain stable forever, only managed, delayed, and disguised. The warning is not that collapse is guaranteed tomorrow, but that the longer people remain unaware of how money truly works, the fewer choices they will have when the next crisis arrives, because history shows that financial control rarely moves backward on its own. The open-ended question left hanging is whether transparency, reform, or alternative systems can emerge before trust breaks again on a global scale. And if you want to understand the forces shaping your future before they make decisions for you, subscribe to the channel, because this story doesn't end here. It's unfolding right now.